Silver hit an all-time high of $121 per ounce just 2 months ago. Today, it's sitting at $67. That's a $54 drop in 60 days. And you know what's crazy? Most people have absolutely no idea why this happened, or more importantly, what comes next. In the next 20 minutes, I'm going to break down exactly what is going on with silver right now. The dollar, the Fed, Iran, gold, platinum, all of it. And I'll do it in a way that even if you've never bought a single ounce of silver in your life, you will walk away understanding this market better than 90% of the people in it. Stay with me. This one matters. Before we dive in, nothing in this video is personal financial advice. I'm here to break down what's happening, what analysts are saying, and what tools you have available. Always do your own research and speak with a qualified advisor before making any investment decisions. Where is silver right now? All right, let's set the stage. As of March 24th, 2026, silver is trading between $67 and $69 per ounce. Now here's what makes that number so shocking. Just 8 weeks ago, silver hit $121, an all-time record. That means in roughly 2 months, silver has lost nearly half its value from the peak. If you had invested $10,000 at the top, you'd be sitting on about $5,600 today. That stings. But, and this is really important, zoom out just a little and the picture completely changes. Year over year, silver is still up over 100%. So if you bought a year ago, you've more than doubled your money, even after this brutal correction. So which story is true? Is silver crashing, or is it still in a massive bull market? The answer is both, depending on your time horizon. And by the end of this video, you'll know exactly how to think about that. The 3 forces driving silver today are exactly 3 forces moving silver in the short term right now. And I promise, by the end of this section, this market will make complete sense. Driver 1, the U.S. dollar. Here's one of the most important relationships in all of investing, and most people never learn it. When the dollar gets stronger, silver gets cheaper. Every single time. Why? Because silver is priced in U.S. dollars globally. When the dollar rises, the price of silver in dollar terms falls. Right now, the dollar index, called the DXY, is sitting around 99.25 to 99.32. It's been stubbornly firm, not spiking, not crashing, just grinding higher, quietly dragging silver down every week. Think of the dollar as a heavy weight on silver's shoulders. Every 1 point rise in the dollar typically knocks 1 to 2% off silver's price. That doesn't sound massive in one day, but when it's happening week after week, it absolutely adds up. And the reason the dollar is strong right now? That's our second driver. Stick around, because what the Federal Reserve just said about interest rates, it's going to surprise you. That's coming up in about 2 minutes. Driver 2, the Federal Reserve. On March 18th, the Federal Reserve held its most recent meeting. They kept interest rates at 3.50 to 3.75%. Now that sounds boring. Nothing changed, right? But what actually happened is what Fed Chair Jerome Powell said around that decision. His tone was what analysts call hawkish, which in plain English means we are not cutting rates anytime soon. And then came the real gut punch. The Fed upgraded its inflation forecast. They now expect prices to stay higher for longer, partly because tensions in the Middle East are pushing oil prices up. Markets had been pricing in 2 or 3 rate cuts this year. After this meeting, the Fed's own projections, called the dot plot, now show just 1 cut for all of 2026. Here's why that directly hammers silver. Silver sitting in a vault earns you 0%, but a U.S. Treasury bond right now pays you 3.5%. So, when the Fed signals rates are staying high, big institutional investors start asking, why do I hold silver when I can make 3.5% doing nothing? And they sell hard. This is called opportunity cost, and right now, it is the single biggest headwind for silver. All right, driver number 3. This one is the most dramatic. Driver 3. U.S. Iran Geopolitics. For the past several weeks, markets have been watching one story closely. Will the United States take military action against Iran? Specifically, could the U.S. target Iranian energy infrastructure? When that fear is high, silver and gold spike. People panic buy hard assets when the world gets scary. When the fear eases, silver drops as that rush reverses. Here's exactly what happened this week. President Trump announced a 5-day pause on potential strikes, citing productive talks with Iran. Silver immediately dropped. Then, Iran came out and denied any formal negotiations were happening. This is why silver is swinging 3 to 5% in a single day right now. It's not fundamentals. It's literally single headlines. If you're day trading silver based on news right now, good luck. It's basically a coin flip. But if you're a long-term investor, this is just noise. And I'll prove exactly why shortly. Silver versus gold, what most people get wrong. Here's something most investors get completely wrong about silver and gold. This is really important, coming right up. People often treat silver and gold like they're the same thing. They're not even close. Here's the clearest way to think about it. Gold is the defensive player. Silver is the offensive player. Gold is about 90% monetary. Institutions buy it purely as a safe store of value. Silver is about 50% monetary and 50% industrial. It powers solar panels, electric vehicles, semiconductors, and medical devices. That dual identity is exactly why silver went up 145% in the recent bull run. While gold went up 65% over the same period, silver has more upside, but it also has more downside. Right now, the gold to silver ratio is sitting around 64 to 66. That ratio is widening, meaning silver is falling faster than gold. This is a classic signal of macro-driven selling. When institutions panic, they dump the industrial assets first and hold the monetary safe haven, gold, a little longer. Numbers over the last 30 days. Gold down about 8 to 10%. Silver down 20 to 24%. Same drivers. Silver feels it 2 to 3 times harder. So why would anyone own silver over gold? Because when the tide turns, and it always does, silver bounces back 2 to 3 times harder as well. That's the trade-off. That's the bet. Platinum, Palladium, and the PGMs. Now let's go one level deeper, because silver isn't the only metal getting hit. Let me introduce you to the platinum group metals, the PGMs. These are platinum, palladium, and rhodium. Platinum, around 1,850 to 1,910 per ounce. Palladium, around 1,430 to 1,450 per ounce. Rhodium, around 10,600 to 10,900 per ounce. These metals are even more industrial than silver. Platinum goes into hydrogen fuel cells and auto catalysts. Palladium is in every gasoline-powered catalytic converter on the road. Rhodium, almost entirely auto emissions control. Because PGMs are so tied to manufacturing and car production, they get hit even harder than silver when the Fed keeps rates high. The logic? Higher rates mean higher borrowing costs, which means fewer car loans, which means slower car sales, which means less demand for auto catalysts, which means PGMs fall. In the last 30 days, platinum down 20%, palladium down 22%, rhodium down 18%, roughly matching silver, but without silver's monetary cushion. Now here's the interesting one. Platinum. It has a long-term weapon. As the world builds out hydrogen fuel cell technology, platinum's demand looks completely different from palladium or rhodium long-term. And one supply fact you need to know: 70% of all platinum in the world comes from one country, South Africa. Any disruption there, power outages, mining strikes, and platinum can spike hard and fast. The physical silver story. What's happening right now in the physical silver market is genuinely surprising, and most retail investors have never heard about it. Don't skip this part. Okay, here's where it gets really interesting. There's a narrative going around that major institutions are abandoning paper silver contracts and demanding actual physical silver bars stored in vaults. And the remarkable thing is, this part is actually true. Real numbers from COMEX, the main U.S. silver futures exchange. In all of 2025, 474 million ounces of silver were physically delivered on COMEX. In January 2026 alone, 49.4 million ounces delivered. Right now, March 2026 futures have 37.7 million ounces still standing for delivery. And COMEX's registered inventory, the silver actually available to be physically delivered, has dropped to around 79 to 88 million ounces. If delivery requests continue at this pace, you could drain a massive chunk of what's available in just a few months. 3 reasons this is happening. 1. New banking rules. Regulations called Basel III require banks to hold more physical assets. Real silver bars qualify. A paper contract on a spreadsheet, less so. 2. Geopolitical hedging. With Iran tensions and trade uncertainty, large players are physically moving metal from London to New York vaults. 3. Worst-case scenario planning. Some major institutions are hedging against genuine systemic risks. Should you be panicking and buying silver bars tonight? No. But should you understand that this physical tightening is real? Because it's a core reason the long-term bull case for silver remains intact, even as the price gets hammered short-term. Let's talk about what actually matters for anyone with a multi-year horizon. The short-term noise, Iran, the Fed, the dollar, will resolve. It always does. What doesn't resolve itself is structural supply and demand. Solar panels alone could add over 200 million ounces of silver demand per year by 2030. Every solar panel contains silver. There's no cost-effective substitute yet. Electric vehicles, silver is in every charging system, every circuit board, every battery management system. And mine supply? It's been running at a chronic deficit for years. More silver is consumed than is pulled from the ground. That gap is widening. So here is the honest summary. Short term, silver is getting hammered by the Fed, a strong dollar, and Iran headlines. It could still drop towards $64 to $65 if things calm down geopolitically. Long term, the fundamental case is as strong as it has ever been. Solar, EVs, electronics, physical vault demand, and declining mine supply are all pointing in one direction. The question is never if silver recovers, the question is when, and whether you have the patience to hold through the volatility that comes before the recovery. What should you actually do? Okay, I know exactly what you're thinking. Great, but what do I actually do with all of this? 3 practical takeaways. 1. Don't chase short-term moves. Silver swinging 5% on one Iran headline is not an investing opportunity. It's a coin flip. Don't trade around geopolitical news if you're new to markets. 2. Know your time horizon before you buy anything. If you need this money back in 6 months, silver is not the right place for it right now. But if you have a 3 to 5 year horizon and you believe in solar and EV demand, the structural case is genuinely compelling. 3. Watch the right signals. The things that will tell you the silver trade is turning. The Fed signaling actual rate cuts. The dollar weakening. Iran tensions clearly resolving. COMEX physical inventory continuing to tighten. When those signals align, the same macro headwinds we've discussed today will flip into tailwinds, and silver has the potential to move very fast in the other direction. All right, that's the full picture on silver right now. We covered where silver is today and why it dropped so hard. We broke down the 3 real drivers, the dollar, the Fed, and Iran. We compared silver against gold and the platinum group metals. And we looked at why the physical silver market is tightening in ways most people aren't talking about. If this was useful, hit the like button. It genuinely helps more people find this content. If you want me to go deeper on any of these topics, the Fed dot plot, how to actually buy physical silver, or how platinum compares as an investment, I read every single one. And if you're new here and want to keep learning about investing in plain English, subscribe. I'll be back with more. See you in the next one.